Yo, all right. I'm here to talk about investing and how you can start investing. I myself am a young adult. I myself am investing. Why should you trust me? Me personally, I would rather take advice from a normal dude in a sweatshirt at his home desk than some guy in a suit and tie on the middle of a beach in Dubai saying, buy my course. I'm not selling a course. I'm just spitting some words that I researched on and I feel like could be a benefit to society to know. So if you're in your teens or early 20s, now is the perfect time. The earlier, the better. Legally, you're allowed to open a brokerage account at 16. I opened my first one when I was 18. It doesn't really matter. The general rule is that you want as much time as possible for your investments to grow. So first things first, I think it is important to understand why we're investing. Investing isn't a get rich quick scheme. It isn't a way to have $1 million by tomorrow morning. I'm just gonna give an example. The stock market. The stock market represents ownership in an individual company and their shares. As of right now, I think Apple's stock price is at $231.30. Now here's the thing. If you invested in Apple 10 years ago, you would have made a 927%, or basically 9 times your money. So you turn $1 into 9. And the same with Microsoft. Microsoft's 10-year return is 1,015%. So you would have 10x your money, $1 into $10. Now here's the thing. The stock market, or at least in these individual companies, moves up and down anywhere from literally 0% to 5%. But when you buy a share of Apple and say you bought it for $200, you're not gonna have $300 the next day. In most cases, you're not gonna have it the next week. It usually takes well-timed investments, seeing stock market conditions, timing earnings reports, looking at their earnings reports and financial reports, because these companies are legally obliged to provide those financial statements. All right, now here's the basics of the stock market. When you buy a share of Tesla, Netflix, Apple, Microsoft, you own part of that company. That tiny ownership is just gonna be fluctuating based on that company's value. So, say you think Netflix is gonna be the biggest thing, as if it's already not the biggest thing. You think it's gonna be a bigger thing in 10 years. Your tiny investment of one share, which is probably like what, 400, 500 bucks, may be worth 600, 700, 800 bucks in 5 years. Now, vice versa, say Netflix absolutely dumps, it crashes. No one's using Netflix anymore. Everyone's on Amazon Prime. That 500 bucks, that $400, $500 purchase of a share might now be worth 300, 200. Now, if you're just getting started, one of the really easy ways to invest in the stock market is ETFs. ETF stands for Exchange Traded Funds. Some examples can be the S&P 500, Invesco QQQ, Vanguard has a couple of them, Schwab has a couple of them. What you're getting is a share of a fund. That fund is built on shares of all these individual companies. So basically, you don't actually have to choose the companies. You can just choose this conglomerate of companies. So an example can be Invesco QQQ is comprised of mainly big tech stocks. The S&P 500 is comprised of the top 500 companies in America, I believe. So now, how can you do this? I'm spitting a bunch of jargon, but I'm not actually telling you how. Here's the thing. Say you're watching this on your phone or your computer. You go to your app store and you download a really easy app, Robinhood or Webull. They let you invest with $1. Literally, you just need $1. And from there, you will sign up, do all the little email password and all that fun stuff you do, deposit some money from your bank, which should be pretty self-explanatory, and boom. It's a click of a button. You click buy, you click sell. Webull and Robinhood are the easy, user-friendly ones. If you really want to get more advanced after you do your own research, you can use platforms like Thinkorswim or Fidelity or whatever you want to use. That's up to you, but it generally is the same thing. You buy a share, you buy a stock, you buy an option contract, you buy this, you buy that. Now, one thing that's really cool about a lot of these user-friendly apps is that you can automate it. You can literally automate your investing so you can forget about it. One way you can do is Webull, you can automatically set it up to where you'll invest 50 bucks into the S&P every month, or you'll invest 100 bucks into Apple every month. Something along those lines. It's up to you. Now here's the thing. The stock market's great. You might have seen this video after searching up Wall Street bets. When you go on Wall Street bets and you see them all making 1,000,000% on GameStop and AMC earnings, this is what you should avoid. All of that. Chasing hot stocks or trends just because you see other people making 1,000,000% on it usually makes you, who's already late to the news, the bearer of the consequences of those hot stocks. Everything that goes up must come down. GameStop, AMC, all these examples that you see where these big put investors on Wall Street are losing a bunch of money, they made most of that money back because GameStop immediately dropped again. That's why it's usually a better idea to stay consistent with your investments and go the safe route. Because as much as someone would like to say, hey, I made 1,000,000% in a day, you could also say, hey, I made 1,000% in a couple years, but I didn't go into massive drawdown. The odds of making that 1,000,000% in a day are so low, it's a low probability of you doing it. And you also don't want to be the one college kid calling your dad saying, hey, I ran out of money because I threw all my money in Nvidia on earnings. And I got the tip from some guru on Twitter wearing a suit and tie on a beach saying, hey, buy my courses, buy my signals. And just to give you guys some ear and eye candy for why you should want to invest, I'm just gonna list some of the top performers from the past 5 years. So say you started college, you're a freshman in high school, throw $1,000 into one of these companies, and maybe when you graduate, you'll have a little bit more. Who knows? Nvidia's 5-year return, 2,690%. Tesla's 5-year return, 1,500%. Coca-Cola's 10-year return, 1,600%. And just a little eye candy and ear candy for those who don't want to go into individual stock companies and just go into ETFs. Here's the S&P 500's returns from recent years. Going in descending order from 2024, 22%, 24%, minus 19%, 26%, 16%, 28%, minus 6%, 19%, 9%, minus less than 1%, 11%, 29%, 13%, 0% in 2011, and in 2010, 12%. I'm no genius in math, but from what I just spoke, I think it would have been a safe investment to invest in the S&P 500 14 years ago, because in 2010, the S&P 500 was worth $1,139. Today's market value, $5,290. That's the end of the video. That's my basic advice. So for those that want to go invest, you actually have to go do something yourself. Click off this video and go do something yourself, because you're not going to start investing without actually investing. So yeah, until next time, toodaloo.